Eight ways to avoid paying taxes legally. Doesn't everyone just love tax season? Answer: literally no one. In 2017, the IRS released a report that shows the average U.S. federal tax income rate for all income levels was 14.64%. And according to the Bureau of Labor Statistics, the average American income in 2017 was $73,573. Crunching the numbers tells us that Americans paid an average of $10,771 in federal taxes alone in the filing year of 2017. And that doesn't include state and local taxes. Even though these numbers are averages, the point remains that we pay a lot of taxes every year. While tax evasion is illegal and should never be considered, there are ways to avoid paying an excess amount of taxes legally. You may even be paying some taxes that you shouldn't be in the first place. Before the next tax season rolls around, check out these ways to avoid paying taxes and maximize your hard-earned cash. Number 1. Itemized deductions. I get it. Providing proof for itemized deductions can seem like a real pain, but it might be extremely worth your while. If you have paid significant amounts of money toward local and state taxes, property taxes, medical expenses, charitable contributions, or mortgage interest, you could be owed hundreds, even thousands of dollars in itemized tax deductions. Does it seem like a lot to process? Luckily, the IRS has an interactive tax assistant online that can help you determine the deductions you may be eligible for. And it only takes 5 minutes to complete. You can use this assistant to help you figure out which deductions is most beneficial to you: an itemized list of your purchases or the standard deduction. Number 2, tax credits. Tax credits equal free money. These tax credits reduce the amount of taxes you owe and can turn into a hefty refund for you. While many people are familiar with tax deductions, few realize that tax credits are also available. There are several tax credits offered by the IRS. You can obtain these credits based on a range of things, such as your income level, health insurance premium payments, or if you've bought energy-efficient products for your home. To take full advantage of tax credits, you'll need to estimate all of the major purchases you've made in recent years. Be sure to document any spending that could help you qualify for investment and saving credits, healthcare credits, real estate and home ownership credits, and education credits. Number 3, municipal bonds. Investing in municipal bonds is another elusive concept for many taxpayers. Essentially, a municipal bond is when you lend a set amount of interest payments to a local or state system over a predetermined period. The full amount of your investment is paid back to you once the bond reaches its maturity date. Some municipal bonds are exempt from state and local taxes. It depends on where you live. But they are all exempt from federal taxes. They're attractive to investors since they are simple tax-free investment payments. Traditionally, municipal bonds have lower default rates than corporate bonds, 0.1% versus 2.28% respectively. But municipal bonds also pay lower interest rates than that of their corporate bond counterparts. If you decide to invest in municipal bonds, you have to understand your tax equivalent yield. The higher your tax bracket, the higher your tax equivalent yield will be. Number 4, max out your retirement accounts. This concept is always a best practice, but especially when trying to avoid as many taxes as you can. As of 2020, you can reduce your taxable income by up to $19,500. Here's what I mean. If you earn $100,000 per year, but you contribute $19,500 to your 401k or 403b, your taxable income will only be $80,500. If you don't have a retirement plan through your employer, You can take advantage of this tax break by contributing up to $6,000 to a traditional individual retirement account, or an IRA. This is not to be confused with a Roth IRA though. With a Roth IRA, your contributions can only be made with after-tax dollars, while traditional IRA contributions can be made with pre- or after-tax dollars. The traditional IRA allows you to reduce your taxable income. Number 5, use an HSA, Health Savings Account. To further reduce taxes, people with a high deductible insurance plan can also use an HSA. With an HSA, you contribute pre-tax dollars to your account, much like an IRA or 401k. In 2020, the maximum contribution for an individual are $3,550 and $7,100 for a family. Once you start contributing to your HSA account, that money begins to grow without any taxes being enforced on the earnings. An added benefit of an HSA is that withdrawals are not taxed, so long as they are being used to pay for qualified medical expenses. Number 6, focus on long-term capital gains. Investing is a critical tool for growing your wealth, whether you plan to use that wealth now or in retirement. Investment choices range from real estate to mutual funds, and bonds to stocks. In addition to increased riches, the tax breaks are quite favorable for long-term capital gains. If you hold an asset for over 1 year, you could see a preferential tax rate of 0%, 15%, or even 20% on the capital gain. That specific rate is dependent on your income level. However, if you hold that same asset for less than 1 year, the capital gain will be taxed at standard income rates. Growing your wealth in this way relies heavily on your understanding of the difference between short-term and long-term capital gain rates. This method can get a bit complex, so it may be beneficial to recruit the help of an investment advisor or tax planner. They can help you evaluate your assets to minimize losses and maximize gains in the long term. Number 7, back to school. Enrolling in college is another way to capture all of the tax credits or deductions that you can. You could take advantage of one or the other. The government usually doesn't offer both when you go back to school in person or online. There are 2 main education tax credits that students can take advantage of. First, there is the Lifetime Learning Credit. It can give you up to $2,000 to help cover the costs of course materials, fees, and tuition. The second is the American Opportunity Tax Credit. This credit can offer you up to $2,500 off of fees, tuitions, and of course, course materials. Only one of these tax credits can be claimed per year, so choose wisely. It is also worth noting that grants, work studies, and other forms of financial aid are not taxable. It doesn't count as taxable income. Scholarships are also not taxable, so long as the money is used for school-related expenses such as books, supplies, equipment, fees, and of course, tuition. We've come to our 8th and final way to avoid taxes. But before we share that, we have some funny stories about the interesting ways people have tried to avoid taxes in the past. First, cool cats. Jan Van Dusen was an extreme cat lover who slowly accumulated over 70 kittens living in her house. She began caring for the strays she found around her home. In some instances, she would release the cats back into the wild. But most of the time, she fostered them in her house while she tried to find forever homes for her furry friends. Naturally, the expenses started to pile up for Van Dusen, and in 2004, she attempted to write off $12,068 for rescue items like vet bills, food, and more. Unfortunately, she was informed by the IRS that those were considered to be personal expenses and therefore could not be deducted. Rather than accept defeat, Van Dusen sued the IRS, which turned into a lengthy legal battle. In the end, she was able to prove that her cat care program was a charity, not a personal project, and the IRS honored the deductions on most of her claims. Second, NBA expenses. Former NBA star Lamar Odom sued the IRS in 2010 because agents said that Odom owed, wait for it, $87,000 in taxes. In reality, Odom claimed tax deductibles for $178,000 in training and fitness expenses and $12,000 in fines. While the IRS insisted that he could not take deductibles for those kinds of expenses, the NBA player argued that they were necessary expenses for his profession. He testified, "These fines are commonly assessed on professional athletes and are work-related. Therefore, the fines incurred are ordinary and necessary employee business expenses." The case was not settled until 2012 when the IRS agreed to take only $9,000 in owed taxes from Odom, a far cry from the original demand of $87,000. Today, Odom would not be able to make the same claim thanks to the Tax Cuts and Job Act. Now, only self-employed individuals can make job-related expense deductions. Third, around the world in 50K. Tax preparer Jerry Lewin recounted the tale of one of his clients to CNN Money. This client took an extravagant multi-year trip around the world. He stopped in places like Greece, Italy, France, and it only cost about $50,000. Lewin's client wanted to write off the entire trip, so he published a book about his travels. This book was no New York Times bestseller, oh no. It sold maybe about 20 copies and was published by a tiny publishing house. However, the fact that the book was related to his worldwide travels was enough. He was able to write off the entire trip as a business expense, thanks to his book. We've come to our 8th way you can avoid paying your taxes. But before we get there, consider subscribing. And don't forget to ring that notification bell. And if you like this content, hit that like button and comment below. What's the 8th way to avoid paying your taxes legally? Start your own business. While this is the most involved of all the options, it also has the most significant income potential. Not only does it offer many tax advantages, but building your own business will create additional income. Many expenses used to pay for daily business functions can be deducted from the income generated from your business. This will reduce your total tax obligation by quite a decent margin. Health insurance premiums are especially important tax deductions to pursue if you go this route. Keep in mind that it can be possible for a business owner to deduct a portion of their home expenses as part of a home office deduction. This business owner can also deduct a portion of internet costs and other utilities from their income. Of course, there are restrictions from the IRS regarding these deductions, but it is possible. Those are our 8 ways to avoid paying your taxes legally. Thanks for watching Cerebral Life, where you learn more and improve your life. See you next time.